Hello everyone, Alex Kim here. What we're observing in the silver market right now is a repricing dynamic that many analysts are still failing to model correctly, and the implications for mining equities are being dramatically underestimated. As silver prices continue to rise rather than revert to prior ranges, the earnings assumptions that underpin analyst models for silver mining companies are becoming obsolete in real time. Analysts who built their forecasts around conservative silver price scenarios are now being forced to revisit those projections and acknowledge that profit margins could be substantially larger than previously expected. Despite the fact that many silver stocks have already appreciated 4 or 5 times from their lows over the past year, this rally must be understood in context. Valuations were extremely depressed at those lows, and even after the substantial gains we've seen, many companies remain historically cheap relative to their future earning potential under a sustained higher silver price environment. As expectations reset and analysts incorporate more realistic price assumptions, stock prices will need to be repriced higher to reflect the stronger margins and the durability of demand that's now becoming apparent. At the macro level, the shift is even more structural. Central banks are steadily reducing their exposure to US dollars and treasuries in favor of gold, which is fundamentally altering the demand profile for US government debt. Simultaneously, global investors are beginning to redirect capital away from US assets and back into domestic markets, reversing decades of capital flow patterns that the US financial system has depended upon. These changing capital flows represent a major structural challenge for the United States and could serve as a powerful accelerant for the long-term bull market in precious metals. Now let's examine the specific dynamics driving this move. Silver is finally catching up to gold, after a prolonged period where gold was the only precious metal advancing meaningfully. Platinum is also beginning to follow gold's lead. In all historic precious metals, bull markets, silver tends to outperform gold, and that pattern is now reasserting itself. We should expect continued appreciation in silver, accompanied by higher volatility than gold, but both metals have substantial room to run from current levels. The fact that silver is now leading is actually a positive confirmation signal for gold. For years, one of the critiques leveled against gold's advance was that it lacked confirmation from silver, and many participants believed that this divergence would resolve through gold declining rather than silver rising. That thesis has been proven incorrect. Silver has made up significant lost ground, and the metals are now moving in sync, which validates the broader bullish thesis. This is not a retail story. What's particularly interesting from a mining perspective is how rising silver prices impact the economics of gold production. Many gold mining companies also produce silver as a byproduct, but they often don't report silver as a separate revenue line item. Instead, they use silver revenue to offset their cost of production, which means higher silver prices effectively reduce the cost of extracting gold. For these mining companies, the two largest costs outside of labor are energy and the opportunity cost embedded in their silver byproduct. Energy prices are currently as low as they've been in recent memory, and the revenue they're generating from silver has multiplied. Silver that used to generate $20 or $25 per ounce is now generating $95 per ounce or more, depending on timing. That difference is enormous for mining economics. In some scenarios, the silver revenue could become so substantial that companies are effectively extracting gold at zero marginal cost or even negative cost. This dramatically changes the profitability profile of the entire sector, and it's a dynamic that hasn't fully been incorporated into equity valuations yet. Some gold mining companies that previously paid limited attention to their silver production may now begin to prioritize it more strategically, given the economic incentive that's emerged. Now, I want to address a comparison that continues to circulate, which is the idea that Bitcoin functions as digital gold. Bitcoin is not digital gold, not in the physical sense, and not even in the financial sense. Bitcoin cannot be used for any of the applications that gold serves, and more importantly, it doesn't trade with any correlation to gold. People who purchased Bitcoin under the assumption that it was supercharged gold expecting that if gold rose, Bitcoin would rise even more, need to recognize that this premise has not been validated. Gold's price movement has no bearing on Bitcoin's price movement. Bitcoin could just as easily decline while gold rises. The two assets are fundamentally different. If you want to compare Bitcoin to anything, it correlates more closely with risk assets, such as money-losing technology stocks. It's speculative in nature, lacks fundamental intrinsic value, and operates on a greater fool theory where valuation depends entirely on finding a subsequent buyer willing to pay more. The problem with that model is that the greater fools may already be in the market, and there may not be sufficient new participants left to sustain the structure. Many people should be concerned about this dynamic, but aren't. Shifting to broader macro risks, there are growing signs of stress in global bond markets, particularly in Japan. I've been expecting a significant dislocation in the Japanese bond market, and what we're witnessing now appears to be the early stages of that event. Yields in Japan are headed substantially higher, and while the fallout hasn't fully materialized yet, it's coming. That stress will reverberate into the US because it will place upward pressure on Treasury yields as well. One of the ways Japan is likely to respond is by selling US dollars in order to pay down Japanese debt and reduce their interest expense. That will be a significant negative for the dollar and for US Treasuries because Japan is a major holder of both. Additionally, the yen carry trade, which has been a structural feature of global markets for years, is beginning to unravel. A lot of speculative assets around the world that were purchased using leveraged yen are going to be unwound, and that will create turbulence across multiple asset classes. This is very significant. Japan will need to implement reforms, potentially raise taxes or cut government spending, but ultimately the United States is going to pay the largest price because the US has been the biggest beneficiary of the system that's now unraveling. Are you seeing the same pressure building in other carry trade structures outside of Japan? If you find this breakdown useful, consider subscribing so you can follow how these signals evolve. Now let's discuss where we are in the broader precious metals cycle. The bull market in gold, silver, and mining stocks began around 2001 or 2002. Over the subsequent 10 years, gold moved from below $300 per ounce to $1,900. Silver moved from $4 to over $45, representing a 10 times move. Many mining stocks also delivered 10 times returns during that period. Substantial wealth was created in that early leg of the bull market, much of it in anticipation of what ultimately occurred in 2009, 2010, and 2011 with quantitative easing and 0% interest rates. Gold was ahead of those developments. After that run, we went into a consolidation phase that lasted more than a decade. Gold didn't break out of that consolidation until 2024. Silver didn't break out until 2025. Mining stocks are only now truly breaking out, even though many have tripled or quadrupled from their lows. Some are just now reaching their 2011 highs. Some have exceeded those levels, and others haven't quite gotten there yet. What's happening now is the beginning of a new leg in this bull market. The current environment is more similar to 2001 or 2002 than it is to 2011. That means we're not at the bottom, obviously, with gold near $4,800 and silver near $94, but we're closer to the bottom than the top. The structural setup favors continuation rather than exhaustion. What's changing now is the breadth of participation. Central banks have been accumulating gold for years, but that activity is accelerating. Banks that have been buyers are increasing their purchases, and banks that haven't been active are beginning to enter the market. We're seeing wider participation across central banks globally. Institutional investors are starting to participate, particularly in mining stocks. Retail participation is beginning to build. The difference between 2024 and 2025 versus the current phase is that in the earlier period, central banks were the dominant buyers and private investors, whether institutional or retail, were largely absent. Now all three groups are buying simultaneously. The question that matters is who will do the selling. Where will the metal come from to satisfy this demand? The answer is that it will come from mining production. But mining companies cannot scale production quickly. This is a supply-constrained market. Prices are going to rise, profits are going to rise, and investors who have been patient for years are finally going to be rewarded. Watch the flow, not the headlines. As prices rise, participants will need to commit more dollars to acquire fewer ounces of gold, but the demand will persist because the need for the asset is structural, not discretionary. People will pay higher prices because they must have the asset. That's excellent for mining companies because they will sell every ounce they can produce. There will be no surplus. They will sell all the gold they can extract from the ground at much higher prices, and they cannot extract it fast enough to meet demand. Consider the scale of capital that's chasing a limited supply of gold. Trillions of dollars, euros, pounds, yen, and renminbi, all these fiat currencies competing for a finite amount of physical metal. Central banks continue creating more fiat currency daily, which means the demand for gold keeps growing because it's being fueled by monetary expansion. This isn't speculation. This is positioning. What this discussion highlights is a structural shift in the global gold market that is no longer limited to central banks alone. We are entering a phase where participation broadens across institutions, mining investors, and eventually retail capital. That matters because gold is not an elastic market. Supply cannot respond quickly no matter how high prices go. Mining output simply cannot keep pace with accelerating demand. As more capital competes for a finite amount of physical metal, pricing pressure becomes inevitable. This is not about sentiment or short-term trading. It's about mathematics. Trillions of newly created currency units are being forced to chase an asset that cannot be printed, replicated, or scaled overnight. That imbalance favors higher prices and dramatically stronger margins for mining companies that can deliver ounces into a tightening market. After years of consolidation and patience, the setup suggests a powerful reward cycle may be unfolding for long-term holders. Higher prices don't reduce demand in this context. They confirm necessity. Gold doesn't need to be cheap to be bought. It needs to be trusted. The public narrative lags the positioning, with demand expanding, supply constrained, and capital flows accelerating. The next phase of this market appears less about timing the perfect entry and more about ensuring you're positioned before the window closes. Institutions don't chase price. They manage exposure. The repricing we're witnessing in silver and gold is forcing analysts to update their models in real time, and many are still underestimating how much earnings power these mining companies will generate under sustained higher metal prices. The lag between price movement and earnings recognition creates opportunity for those who understand the mechanics, before the broader market reprices the equities to reflect the new reality. What part of this mining sector repricing do you think is still being underestimated by the market? Leave your thoughts in the comments and subscribe if you want to continue following how these structural shifts develop.